This digital landscape of glowing numerical price data and line graphs is where the false breakout occurs. It is the moment where price pushes past a known ceiling, only to reverse and trap the traders who entered on the move. When a stock approaches a well-defined resistance level, the standard expectation is a breakthrough. If buying pressure is strong, the price should shatter that ceiling, draw in new participants, and establish a higher trading range. This chart shows a stock in a narrow consolidation range with a distinct horizontal ceiling mapped across the prior peaks. The price is compressing, creeping toward that boundary and building tension. While a push toward the highs often looks like market strength, these moments of compression frequently create a structural vulnerability that larger players can exploit. The price pierces the ceiling with a strong green candlestick. For many traders, this visual trigger provokes an immediate emotional response, and that pin marks the exact moment they decide to buy in. Automated breakout algorithms detect the new high and fire off market orders. At the same time, manual traders watching the chart feel the pressure of missing the move, sending a flood of buy orders into the market. Shifting to a 3D view of the order book, a pool of stop losses sits just above resistance. When price crosses, these stops trigger, becoming aggressive buy orders. Institutions use this wave of forced buying to fill their massive iceberg sell orders. Once filled, buying pressure evaporates. The green candle retreats, leaving a long wick, followed by rapid red candles slicing downward. This creates a liquidation cascade. As price drops, breakout buyers' stop losses hit, forcing them to sell, accelerating the momentum. If this is an institutional trap, what should volume look like at the breach? Consider the link between conviction and shares traded. The data reveals an anemic, low-volume bar. Genuine acceptance requires a volume surge 40 to 50% above average. Volume acts as a polygraph test for the market. Without a volume surge, intraday price movement past resistance lacks the conviction to sustain a trend. Let's replay that initial green spike through resistance from the perspective of a disciplined professional. Using closed bar confirmation, they wait for the clock on that specific period to expire. When the timer hits 0, the candle closes below resistance, exposing the trap. Real market acceptance occurs when the core of the trading activity, the candle body, manages to sustain a close beyond the resistance zone. These 3 criteria form the breakout checklist. First, wait for the candle to close. Second, require at least 1.5 times the average volume. And third, reject any breakout attempt that results in a long wick on low volume. Surviving financial markets requires the discipline to analyze underlying structural liquidity. By evaluating the volume profile and waiting for confirmation, you can avoid being baited by the emotional illusion of price alone.